Hello, want to talk a little bit about doing a bank reconciliation. So you see a sample bank reconciliation here. Now, a bank reconciliation, what happens with a bank reconciliation is that the you're really kind of proving, are you're kind of proving what's a good way to put this? It's a way for a company to examine what the bank is showing they have versus what they show they have and kind of reconcile any differences between the two. Um, and basically, what we're talking about is the bank balance or the bank account balance versus the cash account balance that a company has internally. And there's always going to be some differences, some due to timing, or maybe things that the bank has that happen near the end of the month that the company doesn't know about yet. There's going to be some little differences between the two. And what the bank reconciliation is it's a way to examine and kind of reconcile those differences. And it kind of proves that it kind of ties back what the company is saying versus what the bank says. And then basically, whatever the company needs to adjust on their books, then the company would make a journal entry for in order to correct that and show it properly on their books. Now, I've kind of got a copy of a bank reconciliation over here. So you see the name of the company, you see bank reconciliation, and typically bank reconciliations are done every month because basically banks keep up with information based on a calendar month. And so they'll send you a statement or you can pull a statement for every calendar month. So companies should do this on a monthly basis. The bank reconciliation is also a good control because if something is missing, if something were stolen, if a deposit did not make it to the bank or something was stolen out of a deposit, you would see it when you're doing the bank reconciliation. So the bank reconciliation is a good method of controlling cash. So bank reconciliation is very worthwhile for a company, and typically someone that does not do the operations aspects that are on here, like make deposits or write checks, will do the bank reconciliation. So it's typically done by like an accounting manager or the controller or even the CFO in some cases, someone that's kind of above a lot of the processes that take place that relate to items on the bank reconciliation. Someone above that will do the reconciliation. Okay, so let's look at a sample. So basically what you've got to start with is the bank balance. This would be the bottom line balance on the bank statement. And the book balance, this would be the ending cash balance in the account. Now, notice they're always typically going to be different because there are just some timing differences and there's some different little things that tend to be different between the two. So the bank reconciliation is putting those differences down in writing and showing then that the adjusted balance of both with those differences factored in equal and are the same. So we start with the bank balance and we're going to compare what the bank is showing on the bank statement to what the cash account balance for the company is showing. And anything that's part of the bank book balance, but not part of the bank balance is going to be shown on the bank side here. So as we compare the bank balance with our balance, there's going to typically be two differences. One's going to be outstanding checks. These are checks that we've written, and once we write a check and once we send it out, we take it out of our cash balance. And so the company, these are checks the company has written. They've been taken out of the company's balance, but they have not yet cleared the bank. Remember that they have to go where they're going, and then whoever gets these checks has to deposit them, and it takes sometimes a day or two for them to clear the bank. And so these are just checks that we've reduced our balance by them, but they've not yet cleared the bank. These are called outstanding checks, and they're shown as a deduction to the bank balance because they will reduce the company's balance in the bank once they clear the bank. Now, also have deposits in transit. These are deposits that are part of the book balance, but have not yet been recorded as a bank balance. Deposits in transit a lot of times are deposits that were made like after a cutoff. Like a lot of big banks will have a sign that says like any activity done after 2:30 or after 3 will not show till the next day. So if you bring in a deposit at the end of the day, you put a deposit in the night drop, the company's going to show it as far as their numbers, but it won't be in the bank until the next day. And so you end up taking the bank balance minus the outstanding checks plus the deposits in transit, and you have your adjusted bank balance. Now, everything on the bank side is basically just a timing difference. These checks are going to clear sometime in the following month, and the deposit is typically going to come in the next day, the first day of the next month. And so anything on the bank side, just about all the time is going to be a timing difference. There could be an occasional bank error that you would list here, but that's rare. Doesn't happen very often. So this is typically kind of a good example of what you're going to see on the bank side of this of the bank reconciliation. Now, on the book side, what we're going to do is we're going to compare our cash account with the bank statement, and anything that the bank statement has that we don't reflect as part of our cash balance, we are going to list here. Now, some things are going to be additions to that balance. These are things that again are showing on the bank side, showing on the bank statement, but not on our cash balance. So notice that some things are going to be additions, like interest revenue. If we earn any interest on our account, then that's going to be added to our account balance. So interest revenue would be a positive difference. It's an addition to what we're showing. It's something that the bank puts on maybe on the last day of the month. So we won't know it until the following month. So we won't record it till the following month. Now, customer payments. Some companies have it set up where some customers can make payments directly into their bank account. And so if that is the case, if it happens near the end of the month, we might not see it in time to record it during that month. So it would be recorded in the next month. So a customer payment would be an addition to our balance, because notice that these are additions to our cash balance, because these are additions to the bank balance. These are additions to our bank account balance. Both of them are. Now, there also might be some deductions on here, such as service charges or check charge fees, or a lot of fees come with sometimes business checking accounts. So these would be a deduction. These would be things that the bank would probably take out of our account as of the last day of the month. And since they've come out of our bank account, they're also going to be shown as a deduction here. Another thing you might run into sometimes is a check error. And that is, what if basically you wrote a check for 96, you put 96, but you spelled it out as 69, or just the opposite. It clears for a different amount than what you wrote it for. This would be, a lot of times it's just a transposition error. Like I said, you meant to write it for 96, but you write it for 69. It can happen. And so any check errors, if they're a deduction, would be shown here. Now, if they are an addition, they would be basically shown up here. I just did one as if it were a deduction here. And notice you would start then with the cash balance. You would add in any additions, you would subtract any deductions, and you would come down to the adjusted book balance. And these two should be the same. The adjusted bank balance, the adjusted book balance, they should equal. So again, we've basically taken what the bank is showing, what we've got on the bank statement. We've shown what we have with our cash balance. We've kind of shown on each side anything that the other party has that the bank statement, that anything that we've got that the bank doesn't have is on the bank side. Anything that the bank has that the company doesn't have is on the book side or on the cash balance side. And these two should equal. The adjusted bank and the adjusted book balance should equal at the end of the period. Now, one thing to think here again is, like I was saying a minute ago, everything on the bank side is a timing difference. There's nothing we have to do with it because it's going to clear the bank in the first few days of the next month. But anything on our side over here, we've got to basically record a journal entry for this. So basically in this case, what we've got to do is the additions, for example, interest revenue. I did a journal entry how we would correct that. And notice that anything that's in addition to cash, we're going to debit cash because a debit increases the cash balance. So we would debit cash, we would credit interest revenue. And one thing on our side over here, any of the things that we need to record a journal entry for to get on the books, this is the only way that's going to get on the books, is if we do this journal entry to record it. Otherwise, it'll never get on the books and it would be a reconciling item here forever and just keep building up every month. So we have to do journal entries for what we've got listed on our side or the company side in order to get it on the books. So notice here that for interest revenue, we debit cash, we credit interest revenue. This basically, again, gets it on the books. And notice that for customer payments, we would debit cash, we would credit accounts receivable. So these are pretty common ones you're going to see. Now, notice that everything that was in addition to cash here, we debited cash for. Now, notice down here for the deductions, like the service charge, we would debit like bank charge expense or service charge expense for that amount. And notice in this case, we credit cash. Since this is a deduction to cash, we're going to credit or reduce the cash balance for this. And then notice for the check error, a lot of times it's going to be accounts payable because maybe we're paying like a utility bill or something of that nature. And so I debited accounts payable and I credited cash for this amount here related to the check error. So remember, bank reconciliation compares what the bank is saying versus what the company's saying. You recognize differences between the two to kind of balance it out, and your adjusted bank and adjusted book balance should be the same. Anything on the bank side is more of a timing difference. It's going to clear on its own. Anything on the book side or the company side or cash balance side needs to be recorded as a journal entry. If it's an addition to cash, it's going to be debited to cash. If it's a deduction to cash, it's going to be credited to cash when doing that. So that is all I've got for the bank reconciliation. Thank you. Have a good day.